Okay.
All right, there we go. And we are live. Sarah, good to see you.
Good to see you.
Thanks for finally
Happy to
getting
be
back to
here.
me. I've been chasing after you for a decade now. Good to finally make the connection. So, and congrats on the new role, by the way.
Thank you. Thank you. I know we'll get to share all kind of the insider scoop on
Yeah.
that. I joined this because you joined forces with Rob. So Rob and I
Okay.
go way back. We're two
Okay.
old codgers.
Well, I know Rob's a big Fairway, as am I, fan. I'm sure is that the link with you and Rob?
Yeah. I mean, probably even prior to that, but yes, yes.
Okay.
So
Cool.
huge respect for Rob.
Okay.
So,
Yeah.
Sarah, I wouldn't put you in the codger grouping when
I'm a codger. I'm an old codger with you, Rob, but uh,
I, I think we're relatively close in age, but you've done much better. You're like you know, a fine wine, whereas I'm
oh.
you know, a Diet Coke that's lost its fizz.
That's been set out in the open sun.
Yeah, it's been sitting on the back window of a car, Toyota Celica for too long.
Yeah, as you can tell, this is gonna be a fun one today. Thank you, Rob. Anyway, Rob and I don't know, Rich. I don't want to say we've seen it all, but I kind of think we have seen it all.
Yeah. I mean, it's you guys have been through, a cycle or two more than me, and a lot of crazy ones. So, including this current one that is kind of crazy. So,
Are we in
Yeah.
a cycle? Are we ever not in a cycle?
Some sort of cycle of something that you just have to adjust to every single time. Probably why we love it so much, too, ultimately.
I do like it. I like that about our industry, the constant change.
Yeah.
What it does is it constantly weeds out the weak people when you got to go through there's so many outside influences that affect the business and just the cyclical nature of it. It exposes the people that, are not, don't have the substance to meet the style, I guess. So, and that wasn't always
Yeah.
true in the mortgage industry. So,
I will say this about our sponsor Depth. Uh, they have been through a business cycle or two as well and tend to be very nimble
Mm.
based on what's going on in the business environment. So hats off to them.
that's a great segue, Rob. And let's go ahead and get into it because this is the big picture, presented and sponsored by our friends at Depth, depthpr.com, the best in the biz for storytelling, brand management, strategic communication, public relations. The best in the biz, Carrie Milam, Leslie, Lindsay, and the crew. So you need your story told, depthpr.com. So and I am Rich Swerbinski with not the Mortgage Collaborative, with Onward and Upward Consulting. I got my old TMC vest on today. It threw me. I almost slipped there for a second. And as always, joined by my esteemed colleague and co-host Rob Chrisman. Rob, on the home front today, right?
Yes.
What is your background though? You have a new virtual background. It looks like a polo field or equestrian. What is
Right.
that in the background there?
It's Reno house backyard.
Oh, okay. Is that where you're going to build your ADUs back there?
Well, it's funny you mentioned ADU because in
Big
Larkspur,
thing.
California, underneath my daughter Marie, we do have an ADU and having trouble with the aforementioned ADU because PG&E, the utility, has a lot of paperwork for us to fill out
Okay.
on that ADU. So,
Trump didn't slash those regulations yet for you? What the hell?
not yet, not yet. But you talking about the difficulty of business cycles and so forth. And I was texting a little bit with Carrie Milan this morning. I spent the morning with my granddaughter Cosette, and that is also difficult. Wonderful, but difficult. So
Oh, yeah.
sometimes I don't know if I would put this business in the wonderful category, but it can be difficult. Spending time with a granddaughter is
Wonderful
wonderful and
and
difficult.
difficult.
Yes.
It's a lot of work. It is. So
And Sarah, you guys operate a summer camp still, right?
No.
I thought, why do I think
We
that?
you could tell the amount of show prep that we do on the big picture. Yes.
I feel like I operate a summer camp. It's so funny, Rob. We have, we have lots of sports going on. So again, people who follow me on social media know, I'm sorry, I'm an annoying mom, annoying grandma, all the things. But we do a lot of sports around here. So my kid, youngest kid, 22, he's graduating from Boise State. He is the most valuable player, D1 tennis single.
Ashton Genty? That's not him, is it? No.
No, Jet
Oh,
Middleton, Jet
okay.
Middleton. Yeah, yeah. And then my son-in-law is the starting pitcher for the Mets. So we have sports stuff going on
Who's your
all the time.
son-in-law? He's a starting pitcher
Uh,
for the Mets?
yes, David Peterson.
Oh, really?
Yeah. Yeah, he's been
Oh,
with the
man.
Mets. Yeah, so there's
He's
a lot of
solid.
we'll probably be talking baseball analogy today on some of my stuff. But anyway, yeah, they're Mets right now are
They're on a
go
roll.
Mets.
They're on a
They're
roll.
on a
I
roll.
got a few of my best friends are Mets fans, and I'm a huge baseball fan. So anytime you wanna take this to baseball direction, I'm okay with that. So,
Yeah, yeah.
but
We'll be talking.
we should give a proper introduction to our guest before we get too far in here. Rob and I very pleased this week to be joined by Supreme Lending's brand new Chief Growth and Marketing Officer, Sarah Middleton. Sarah, congrats on the new role. And
Thank you, Rich.
so if I would
Yeah.
have known that all I had to do was throw Rob's name around to get you to respond to my flirtatious inquiries over the years, I would have done that a decade ago. So, but now I know. So there we go. But
Yeah,
Sarah, welcome to the
happy to be here.
show. And congrats. And I guess
Thank
start
you.
by telling us a little bit about the new role and I guess get people caught up on, what's been going on with you these last 4 or 5 months.
Yeah, it's been crazy. It's been wonderful. It's been great. I actually called Rob. He is a consultant. He's an informal consultant of mine. To I asked his opinion on many things in life, and that was one of the opinions I asked him. Yeah, you get to a point in your, in your career, and God bless America. I don't have to do this anymore, and I'm thankful I get to. 36 years in the seat. And I made the decision that I wanted to see what was out there, that I think with the shift in the industry for me, that, there's different flavors. Like here's baseball analogies, right? There's different teams. There's different jerseys that you put on. And sometimes, it fits for somebody and sometimes it doesn't. And I think when you've got to find the right team for who you are, that was the shift for me. And the shift was looking at, for me, the landscape of the industry, and not to say that I'm the amazing Kreskin. I'm taking us way back, Rob, but looking at the industry and going, okay, where can loan officers, branch managers thrive the very best that I can see in this current environment? And to your point, Rich, you always have to be able to pivot. You have to, and you have to be able to shift with things. And like you said, the culling of the herd, when people don't shift, is when you see them ultimately, they end up not making it, or companies not make it. And so I went on this journey of exploration, and Rob knows I reached out to a number of places, and also they reached out to me, thankfully, because I didn't know that I was, if I would even at this point in my life at 65, even who would even be interested. But it was kind of crazy. A lot of companies did inquire, and here's what I heard too. I heard back from people that said, we know your consistency and your work ethic, and that you grind. And I do. I just show up every day. Rob knows this about me. It doesn't matter. I could have a bloody stump, and I'm going to drag in and be here and do what I said I'm going to do. And I think that's also maybe something a little bit missing in our industry today, is if you say you're going to do something, do it. and show up, and there's opportunity right and left if you just do that one simple thing. Anyway, so we can talk more about Supreme, but yeah, there's a whole bunch of cool things that filtered it out for me. But again, that jersey may not be for everybody, and I get that, but it was for me.
I love it.
Thank you,
Another great-
Deborah.
like
And Deborah loves the Mets too. Thank you,
the Mets.
Deborah.
There you go. I mean, it's like, you got another baseball analogy. It was like the Juan Soto free agency tour you had. Were you flying around with Soto to all these? Were you on Ron Leonard or Victor from G-Rate's private Learjet in any of this?
No.
No.
No, that was kind of a non-starter for me. I don't know. Hey, do you want to dive into all that, Rob and Rich? We can dive into the why. I was
Yeah, let's get into it. Let's start with some of the craziness going on in the market, and then we'll
Yeah,
pivot
go
back
ahead,
to
Rob.
the Sarah World Tour and all the great things going on at Supreme.
Well, I don't want to completely drop this topic. I want to come back to it, Sarah, but the fact of the matter is that many people, practically everybody in our business changes jobs at one time or another.
Yeah.
And I think that we don't have to know the specifics about why you left a company or went to a company, but I think it's important for people to understand the process that you went through and what
Yeah.
in your mind makes sense or doesn't make sense in terms of providing a framework to others who are thinking about some kind of change. And, some people, when they go to the store, they go without a list and they end up buying too much, or they end up like me, gravitating towards Captain Crunch and Cocoa Krispies. And other people go to the store with a list, and it's grouped by, okay, refrigerated stuff, the produce and vegetables, the canned goods and dry goods and so forth. And it's all very organized. And I think it's important for people when they make changes to understand why they're making a change and do it and put some kind of framework into it, and not just say, well, I went to lunch with this company, and the person I went to lunch with, they wanted to split a burger, and I really like people who split burgers, so that's where I went to work. Really?
Yeah.
Is that it? So
Yeah.
I think we should come back to, I think you can add value to folks to understand kind of like I say, the framework about why you have made changes in the past and why you made this change, not necessarily the specifics, but just the thought process.
Absolutely. Happy to do that.
Cool.
Yeah.
Well, Rob, the news cycle continues to be robust. I mean, as I mentioned to you in an email yesterday, it's a great time to host a mortgage industry podcast. Maybe the first time that's ever been said. But just so much every day. It's like it's like more twists and turns than like the most salacious reality show. And the latest, we start this morning. We got a bad jobless claims number that, given everything that's going on with the markets right now, it's some people a little freaked out. And of course, tomorrow's big April jobs number, I guess, puts a little bit more stress on the jobless claims number this morning. UWM in the news once again. Already, I called this last week, if you remember correctly. I said UWM will make a huge splash play in the next week, and we got it. And it's partnership with ICE and MSP, their servicing platform, to bring servicing in house. And then just breaking today, UWM big class action lawsuit, former employees for mismanaging 401k funds. So a lot of action and noise for UWM right now. Of course, Fannie and Freddie released earnings, a combined 6.6 billion with a B in the first quarter when not many mortgage loans were done. And then the CFPB trials and tribulations. Court hearing this week kind of didn't yield anything, but I guess there's a congressional watchdog agency looking in and out of the cuts. And on the flip side, you've got House Republicans that are trying to strip the organization of funding. So all kinds of action right now, Rob. And as always, I hand that all off to you and to get us going here.
Sarah, what do you want to talk about? Out of all that,
Huh. Again, hats off to Matt Ishby and Dan and the continuing war that goes on. I also think it keeps things really interesting. But also one of my things I say to people is don't let the news distract you. And again, these things are important, but how important are they to the day-to-day things that you're committed to in your own mortgage practice? So, not to say I read Rob every day, but I read Rob every day and that's it. I don't get caught up in it and I just go, man,
You're
I got stuff to do. So
you're
go
you're
ahead,
too
Rob.
nice. You're too nice. So
That's
Rich,
true.
let's if you, I'll step in. I'll dismiss some of these things. So the weekly jobless claims, we could come right back next week, right? But the
Yep.
in terms of the jobless claims, we knew something was going to happen with firing or laying off or riffing or whatever you want to call it, tens of thousands of people from the federal government. Of course, initial jobless claims are going to reflect that at some point, which leads right into the CFPB and Doge or whoever trying to lay off 1,500 CFPBers. Uh, I definitely have opinions about the CFPB, as do people on the call. I think, though, and the message that I've been giving groups is that, yes, they wanted to lay 1,500 out of 1,700 CFPB folks off. And then a judge stepped in and said, not so fast. And so now, if I'm one of those 1,500, I'm sitting there thinking, what the heck? What's my motivation to do anything at this point? The CFPB became effective in 2011, and it's followed the political cycles. We talk about this business being so cyclical. The CFPB's directors have followed the political cycles, and which isn't the original intent of the CFPB. The original intent was to protect consumers, Consumer Finance Protection Bureau, and protect consumers in their financial doings, which to one degree or another it is done to varying degrees of effectiveness and varying degrees of being I'll leave it at that, effectiveness. So right now you have a situation where the the director is just a nominee. The director's not been approved yet by the Senate. But at this point, I think Donald Trump has firm control of Congress, and nothing that he doesn't want to have happen is going to happen in Congress. In fact, the as a quick aside, I know the Senate just did not slap his hand uh, with regard to all the tariff fluctuations that he's been going through. The Senate said basically go ahead. So good for the Senate. But in terms of the CFPB, it's important to remember that many of the rules and regulations that we as an industry follow were in place before 2011, were in place before the CFPB came along. And if the CFPB is defunded or removed entirely, which would be politically hard to do, those rules and regulations like RESPA and TILA and fair lending and so forth and anti-redline, they will continue to exist. I will argue that the CFPB has been a focal point of a lot of turmoil in the industry. But as Sarah just typed in, yeah, the state agencies, if you're a multi-state lender, if you're a Supreme, if you're a Union Home, if you're a Fairway, if you're a Guild, the list goes on, you'd rather deal with the CFPB and know the CFPB rather than deal with 50 state fiefdoms who are out there and 50 state attorneys general who are trying to make a name for themselves to one degree or another. So, granted, a lot of the state rules and regulations follow the CFPBs, but you also have a situation where, in general, federal rules and regulations trump state rules and regulations. And so when it came right down to it, you could look at the CFPB and the frequently asked questions and where the CFPB was, had weighed in on certain issues and say, okay, we're safe doing that. Um, Not so much. I don't know if anybody's going to look to, North Dakota rules and regulations there and say, okay, that's the way we want to go here. So it can get very expensive, once again, if you're a multi-state lender dealing with all of these compliance issues. If the CFPB funding is taken away, if they're down to 200 employees and those 200 employees are focused on, say, service members or something like that, it leaves a void that gets filled by other entities. And I think that's a problem if you're a large lender. So I
Well,
don't want, I know, I'm not saying, keep all 1,500 employees, but they serve a purpose. And if you think about it, many of the companies now, many of the lenders now have adapted to the rules and regulations that have been put forth in the last 14 years. And we continue to make loans to borrowers. I mean, I don't think the CFPB has, yeah, there you go, ECOA. I don't think the CFPB has held back lending, say in 2020 and 2021. Gee, we really could have gone gangbusters if it weren't for that darn CFPB. Well, the CFPB was there, and we did just fine as an industry. It's just a matter of the CFPB doing the right thing and not, being engaged in this pendulum, getting industry input, and not just slamming companies willy-nilly. So they serve a purpose. It serves a purpose. I think the purpose, the intent is good. It's a matter of, are they executing on that purpose? And I'll shut up now.
yeah, we'll see what happens. I mean, I think in the coming weeks and months, the fate of the CFPB will be decided kind of once and for all for the next 3.5 years, and be interesting to see which way it goes. So
It's if you think about it, it why is protecting the consumer, why has that become politicized? Shouldn't we all be protected to one degree or another? Why have so many things become politicized, including the CFPB? So,
well, I do think that, and I think it had a lot to do with the tone of the former director too. I think regardless but remember, Trump didn't dismantle the CFPB the first time. He brought in fairly
Kathy Graniger
people.
did a
Yeah.
great job. Great
So
job.
I think that's part of it too. And just, the whole, but I mean, it's just everything's so divisive now and just got more divisive these last couple of years, obviously, and just not good for America and Americans at the end of the day. And I think that's one good example, right? Because,
Yeah, Kathy did a great job. There were enforcement actions, there were things that were going on, but Kathy worked very well with the industry and other industries as well, and really took that to heart. And I think that made a huge difference. And I wish we could go back to that rather than saying, let's lay off 1,500 people who are trying to do the right thing. And let's just like defund the CFPB. Let's bring in somebody like Kathy again.
yeah,
And let's move forward.
yeah. We'll see how that all plays out. And Sarah, getting back to what we were talking about at the outset, your kind of journey, your decision, which ended with you at Supreme Lending. Yeah, if you could just, like to what Rob was saying, what were you looking for ultimately? What your fact-finding mission? What was most important to you as you kind of examined, potential employers, new homes, and
Uh,
that process?
Yeah, and I loved how you asked me that question too, Rob, the process that I went through. And just, to share with everybody on the call and anybody that listens to the recording too. I think, you know, to your point, Rob, I don't think loan officers put enough time and thoughtful consideration into it. And you see it with them making jumps potentially just for a check. And then, they're beholden to that company. They're stuck in a 3-year clawback or whatever, is been put in front of them. And, I would just encourage everybody, if you're not happy where you are, and number one, you have to many times kind of take a step back and look at yourself and say, it's the old adage, when you go through processor after processor, loan officer assistant after loan officer assistant, at some point you have to look at yourself and say, is it me? So that's the first question. Secondly, I think if you are considering making a move and you just realize that, you know, the beauty of our industry is, number one, the competition. And it's never to bash anybody. I love the free agency that we have in our industry. I think it's so fun. And I think it's so fun that each company has its own feel. Again, Rich, to the point about baseball, that's the fun of it. Every franchise has this whole different kind of feel to it. And as a player, you have to figure out who you align with. And so I put together, you know, I talked about it on the Housing Wire broadcast with Diego, because he asked me, and I'm happy to share it here too. But it was my questions, and everybody has a different thing that they need. And, you know, again, I'm blessed because I'm at the point now, I don't have to do it. I want to do it. Like, I want to play. I love being in mortgage. I love helping loan officers, helping managers, pouring into them, taking the, you know, the wisdom or all the mistakes I've made, many. I'm so broken and messy like the rest of us, but also just saying, okay, these are things I learned along this journey. And in that 26-point checklist, there were things I think that most loan officers don't even think about. And, you know, a few of them for me were from the servicing standpoint, seller servicer versus sub servicer. That was a big thing for me to consider. How they ran their capital markets. I know, Rob, you and I talked about that. That was very important to me. Also, time in the chair. Again, you know, it's no knock on brand new companies, but it's just more difficult for them. When you kind of really dig into it, it takes a long time to develop depth of relationships, and that could be bad too, right, Rob? You can be, again, I'm not everybody's flavor. I mean, you know, I certainly have my own share of detractors, and it just happens. That's part of being in this industry for 35 years, 36 years. People like me, some people don't like me. That's okay. But understanding, as I was looking at that checklist, I wanted to know who I went to work for really understood mortgage, knew the depth of it, knew how to run a company efficiently and well, and the cost to manufacture is critical today. That was another point for me on my checklist. I don't know that loan officers always, some do, some don't.
What
But if you
percent of
can,
LOs do you think, Sarah, ask that question when you're recruiting them? Is
I
5,
don't,
10,
I don't think, I
3?
don't know. Yeah, Rob, what do you think? I mean, I don't think anybody even asked that question, but cost to
I think
manufacture.
it, well, I think the questions that loan officers or brokers ask are dependent upon how long they've been in the business.
Mhm.
And when you're trying to recruit somebody who's been in the business for 3 years, their concerns, their issues are different than somebody who's been in the business 30 years. So I think it's related to tenure.
Yeah, I do too. Cost to manufacture affects everything. I mean, it affects your rates, you know, and again, also for me at this point, again, I've been in full on retail, and I've also been in the P&L world. For me, the P&L world is where I wanted to go back to, because I also know, you know, it's not for everybody. Not everybody can manage a P&L. Certainly, you have to have a very succinct kind of focus on the dynamics of all that, and then a company that knew how to run P&Ls and has been running them for, you know, Scott Everett has been running them for 26 years and himself running it for 31. So that was big for me. Another thing that was massive, um, again, Dave Savage, he was another, you know, trusted advisor for me to ask, okay, you know, talk to me, just like Rob and Barry Hibby, all the guys that I've been around for years and years, like I have a trusted advisor group, and asking those questions. And, you know, it's hard because Rob represents everybody. Dave represents everybody. Barry, you do too, Rich. And so again, I wasn't asking like good, bad, just what are questions I should be asking that maybe I'm missing here. Product suite, I think it's everything today. Again, I'm an old loan officer. I competed hard. And again, I'm not good at much, but I was a really, really good loan officer and I did a ton of business. Here's what I'm going to say to every loan officer out there. You must figure out a niche or two or two. And what I mean by that is, you know, the Rockets of the world, whatever, they're gonna, as the servicing is gobbled up and bought, they're gonna grab the vanilla. That's just what's gonna happen. Now, it doesn't mean you can't compete with it. You can, because the depth of relationships that you develop in your, your journey. But if you don't have a niche today that you are really, really good at, I think you're going to miss a big section of the business. And you could also sort of, eject yourself out in the culling of the herd. And so that was important to me. Again, Scott Everett in the chair, 31 years himself, understanding how important it is to have these different niche investors that a lot of IMBs maybe aren't looking at because they might be either unavailable to them, they don't have the capital to back it up. And again, lots of IMBs are doing niche stuff, but I think you have to today. And I think you have to also deep dive into that niche to make sure. People say this all the time. Again, they're out there recruiting and they tell you whatever they think you want to hear. People will say, oh yeah, we have a condo department. Do you? All right, well, let me sit down with who runs your condo department and then let me understand every nook, cranny of that condo department to know that I can actually execute. And I don't think loan officers take the time to look at the big picture of their business to say, what's going to allow me to do really, really well and sustain myself, not only sustain, but also attain a next level for my business. And they don't ask those questions. They take the check, right? I mean, I hate that that's happened in our industry. It wasn't like this, was it, Rob, 10 years ago? It just was not like that.
Maybe I don't. We've seen it happen. To bring it back to baseball, and Rich has heard me rant about this to some extent. But when I grew up a long time ago, you could root
Me
for a
too.
player. You could root for a player. You could root for the team. You knew that player was going to be on that team.
Yeah,
You knew Willie Mays was playing for the Giants. You knew Roberto Clemente was on the Pirates, whatever it was. And, Joe Rudy was on the A's, and that was just the way it is. And now, with the way basketball, baseball, football seem to be, I
yeah,
don't, I've gradually phased out my watching of sports because I don't know when you talk about teams having characters or culture, you wonder like, well, that player, I'm really a fan of that player, but they could be, I'm really a fan of Jimmy Butler, and one day he's playing for Miami, and the next day he's playing for the Warriors. Well, I'm a Golden State Warriors fan, so welcome Jimmy, but he could be gone,
yeah,
next year, and you just can't really do that. And so when you're talking to a loan officer or originator in general, there are some who stay with the company year after year after year, uh, and they tend to be very good at what they do. Whereas, and Sarah, you know more about this than I do, the originators who tend to move around, by somebody waving a paycheck at them or a short-term paycheck, may not learn the system, learn the
yeah,
underwriting, learn the underwriters, learn the personalities well enough before somebody else waves the check at them and off they go. And
yeah.
so I think I'm not telling everybody that they should stick with their company until they retire, but it does, I think, have an impact on
Oh,
them and the culture of the
completely.
company and borrowers.
Yeah, yeah, completely. I think it's such a good point too, Rob, is like I've said this to loan officers, again, figure out the best place that you can be, stay there, build your business. And again, companies change, franchises change, right? It doesn't mean that you stay there forever because it may not be a fit after a certain period of time. and that's okay. But there has to be some sustainability to it. And you also see when loan officers are jumping around, they can't build their business because there's to your point, there's the lack of consistency. There's also the lack of, again, typically if they're jumping like that, they don't have a good little team around them, because that's hard on teammates to jump to. And so they can't get that operational excellence that also has to happen. That was another piece for me with Scott and Supreme is I wanted to, and again, I've been with great franchises and I've been around great champions. I had that as one of my things is I want to be surrounded by champions, the best possible people. And I think I've seen it. I don't want to say I've seen it. I know it all, but your capital markets guy matters, right, Rob? That matters. It's so critical that that person knows it and knows it really, really, really well and has the history of experience in it. And that was Dave Brown. I mean, I know you know him. And so that was important to me. I don't know that's important to loan officers, but it should be. It should be. Because that can be a difference in, a quarter of a discount point that they're working on the rhythm in the secondary markets. And so I know, Rob, you know this way better than I do, but there were things about that I just had in that 26 points that maybe don't matter to others, but they matter to me. So
So somebody asked a question, and I don't have my reading glasses on, but I think somebody just asked a question about technology.
Oh yeah.
And the
Oh yeah.
role of, maybe you could read the question out loud.
Yeah. So here's another funny thing, and I'd love to hear you, Rich, chime in on this, and Rob. The other thing, talking to a lot of companies, it was a little bit crazy town to me on the technology side, because SaaS is very expensive. It's so expensive, and loan officers sometimes too much is too much and it just creates confusion for them. So that was important to me, that not necessarily that the top of the house was Mr. Technology. However, they had to know it. Scott knows technology. And that was really important to me. That was in the 26-point checklist. Not every CEO, and again, Scott has his own warts, et cetera, all the things, and nobody's perfect. And I think you also have to kind of figure out in this, I call it the wheel, like you're looking at each section of the wheel. What can I live with? What can't I live with? If that makes sense. One of the things for me was I went out there. I didn't know that it would be even available to me, but I wanted to get back into marketing. I ran our marketing for Fairway for many, many years. And I love marketing. I love events. I love doing all that stuff. Most companies had it figured out. Scott was very clear. That's a gap for us. Training and onboarding, a gap. There's my husband. This is what happens when you're on Zoom.
I thought it was David Peterson for a second.
Training and onboarding was also something I was insistent on, because I know to grow, if I want to help loan officers grow, training, onboarding, marketing, they all go together. You can't do one without the other. So back to the technology point for both of you, I wanted to see that suite of what is the technology, what's the cost to manufacture that technology, where are we gaining the savings, and what is the plan offshore from a technology standpoint. There were a whole bunch of things around that for me. Again, I don't know that loan officers are asking that question, but technology can bury you in costs. It can bury you in costs. And then all of a sudden, now you're in more bloat on your rates, et cetera. And so I keep going back to that cost to manufacture. Technology was a big part of it. So that more limited but succinct and sniper-like technology was what I was looking for.
This is the big picture. presented and sponsored by our friends at Depth. As always, joined by my esteemed colleague and co-host, Rob Chrisman. This week, the Chief Growth and Marketing Officer for Supreme Lending, Sarah Middleton. And the chat is fired up, Sarah. All kinds of stuff in here. Curious on Sarah's thoughts about bank-owned versus independent. A lot of just general comments on MLOs and what they are or not looking for as they're looking for new homes, and a question about P&L. Why do you like
There's all
P&L
kinds
instead
of,
of broker? So any thoughts on any of that, Sarah, that's coming to the chat?
yeah, right. Yeah, I'm gonna ask you, Rob, like what question should I answer in this thing that you think is important for loan officers?
So you've, I'll, um, well, I don't know, but I do have a question,
Yes.
which I think maybe a lot of people will relate to. So much servicing is sold now. Servicing is sold to, PennyMac or AmeriHome or Freedom or whoever. And the original originator of the loan is oftentimes dealing with a borrower who is bombarded by, or at
Yeah.
least reminded of month after month, of who is servicing their loan. So let's say I do Rich's loan, all right, and then my company sells the servicing to Freedom, and then Freedom. Uh, Hang on
I
here.
do. Oh, hello.
I don't even know
Love
if I
it.
can sell my. I have no
Granddaughter.
homeowner.
My
I have no
husband is
homeowners
strolling
insurance
by.
now
We got
because
the
Oh
of
wait, there's a
dog.
dog. There's a dog.
Yeah, mine are back here sleeping. They're back in their beds.
got me behavioral.
A pug dog. I
Oh,
don't know if that's a pug dog or not, but
yeah.
that's a good guess.
I'm a
All
dog
right.
lover,
So
by
they're
the way,
dealing
and a
with.
grandbaby lover.
So, geez. All right. So I'm talking servicing sales here, Cosette. Go away.
Yeah.
So they are dealing. So Freedom Mortgage servicing that loan and Rich's loan, and so rates move, and I want that loan. I want Rich to show me some business here. As a loan officer, how do I combat the big servicer, the big bad servicer out there?
Oh yeah, yeah, yeah. There's, oh man, this is okay. So I'm going to go back to again. It shocks me, and I'm going to say it to everybody on the that's listening in. If you aren't in touch with your database on a frequent basis, and what is a frequent basis? I think at a minimum, this is why your CRM is so critical, and that you have to your point, Rob. Again, this is time in the chair. One of the things Supreme did was they went with Usurpa from years ago, and I love Dan and Chris because again, time in the chair. There's all kinds of CRMs, and we have a few of them that obviously our LOs use, but I like Usurpa just because again, the advancement of it they're really good at it in a time period. But back to that database, if you aren't doing annual mortgage reviews at least once a year, touching base with your clientele and making sure that you're in front of them, and sorry, not to scare everybody, guess what? Freedom's going to pay. You see it all the time. You see it where they're just pulling. And I just think as a loan officer, that has to be part of your daily practice. You should be spending an hour, at least a day, touching base with your database. It should be as important, if not more important, than your referral partners. That's how I feel. It's a gold mine, and working it, if you're in front of them, again, I've been with my Dr. Randy. I love him. I've been with him 28 years. I always go to him first because I trust him, right? I trust him. Now, there's telemedication going on all over the place. I get hit with the ads all the time. I know we all do. But guess what? I'm still going to go to Dr. Randy. And, maybe you guys think I'm wrong on that, but I just think, again, you end up doing, I think our buddy Ishbia, he put out a stat, which I thought was really incredible, that when you start with a client, you have an opportunity to do their loan 11 times. And you think about it, some realtors Today, they might not even do 11 transactions in 10 years. So why wouldn't I work that database? Not to mention everybody else that they refer to me. That should just be part of who you are and what you do so, the niche, work in your database. I mean, there's a whole, mentality around the pillars that you work to get business, but I think you have a fighting chance. Again, cost to manufacture. If I could be somewhere where that cost to manufacture can compete with Rocket and can compete with UWM, then I'm going to get that loan, because you can play in that game if you stay within typically a quarter. There you go.
There you go.
Good answer.
And my background in the chat, for the record, is real. It's just a picture of my real background that I use as a fake background, so we can put the beautiful Depth logo up there. So,
In fact, Rich, it is rumored that you yourself are an avatar. You are, some kind of.
You kind of look like an avatar, Rich.
It's the Max Headroom hair I got going right now. So you never know. I could be fabricated and just a digital. What are they? AI influencer. That's going to be
This 45 minutes has flown by, Sarah. Thank you.
It has
I
flown
think it's been so fun. So
Yeah.
fun. Am I answering all the things you think rich people need to know that will help them? Because again, that's my goal. If I can help one, then my job is done.
There you go. Well, good stuff. And the time absolutely flew by today. And Sarah, I want to thank you so much for
Yes.
making time to come on the show. Congrats again on the new role and for
Thank you.
insightful conversation and look inside the kind of modern age of recruiting in the mortgage space, which has been hot and heavy, and some very good points about technology. I mean, and just how it has killed mortgage lenders. I mean, so true there. The being sassed to death. It's like, almost, like I've got, Netflix and Max,
Yes.
Peacock and Paramount, and I've got like 14 of these things. I mean, like there's like 8 of them I haven't watched in the last month. And like that's kind of what's happened to mortgage lenders on a bigger level.
It has. And you have to step back and go, what am I doing here? And
Yeah.
what do I actually really need? And what am I actually committed to spend time on? I'm not going to name the name of the technology, but it was kind of funny. I looked at a stat with the technology, and it was just in my own little, kind of test case thing. And it was prior world. We had 897 loan officers who had signed up for it. They were paying whatever it was a month. And then when I really chunked it down, how many of you think were actually using that technology?
60,
At all?
80.
67. 67. And out of the 67, that was just like once in a while in the year. 17 were using it actively on a daily basis. And so again, they said it, forget it, they're paying it. And it's probably like the gym membership. I should go. I should go do that. But, I think that's kind of something that's overrun our industry, because, LOs are like, do you have this? Do you have this? Do you have this? What do you actually really need to function and be very productive as a loan officer? And yes, there are certainly things that you do need, but you don't need it all. And it can also, bloat the company and create high rates. So anyway, I hope that helps.
It does.
All right.
Hey, good stuff, Rob. Good to see you as always. And thanks to all of our attendees for spending some time with us on a Thursday afternoon. This goes immediately to podcast and YouTube, where the majority of you watch. And if you're watching on one of those mediums, join the live. It keeps growing every week, and it's fun. Go to chrismancommentary.com and get signed up for the live broadcast as well. So once again, big thanks, Sarah Middleton.
Thank you.
Really appreciate you joining us, and we will see everybody next Thursday.
Thank you. Thanks for having me on.
Take care, guys. Good seeing you, Sarah.